broadcast on the Moneycontrol Deloitte CXO survey. This is the most definitive survey across industries where we have surveyed about 47 CXOs on a whole host of issues that are on their minds and of course their wish list before the budget. Joining me on the show is also Gaurav Chaudhary, consulting editor at Network 18. And first up we have with us Romal Shetty, CEO South Asia, Deloitte, joining us from Bengaluru, and of course also joining us on the show is Deepthi Deshpande, Principal Economist at CRISIL. Let me come to you, Romal, first. You were in Davos and we saw your interviews and videos coming from there. This time around, Davos was quite, it made headlines for several reasons. There was Donald Trump, there was a big India contingent. What have you come back with, because when we look at the survey that we have done together, the optimism amongst Indian businesses is fairly high. Is that the sense that you got at Davos as well? And is our optimism shared by business leaders across the world?
In life is relative. So I think globally, in Davos, two things just took attention, everything over every other topic, which is geopolitics. So everything to do with geopolitics, whether it's war, whether it's trade, whether it's barriers, all of that, I think was the number one thing. And there was a huge amount of uncertainty. And then, of course, second was, of course, AI and what AI is going to do. So if you compare all of that to how India is still faring, so I think you can clearly see that India is much more optimistic than, and that's what I think all leaders as well globally did say about India. I think they were more bullish on India than probably any other region.
Interesting. I want to, get your thoughts in on what, according to you, is really driving the optimism for India. Because even in the survey, right, it comes across that nearly 80% are very confident about the growth prospects of the Indian economy. And a majority of them felt that India's digital infrastructure and public infrastructure would be one of the key growth drivers.
Yeah, so like I said, I think the sentiment, if I would say the sentiment among Indian businesses is really one of cautious optimism, but sort of anchored in resilience. And I want to again bring that. You look at the world; it's in a bit of a disarray. It's in all kinds of directions. Lots of trade talks, lots of things happening. Supply chains have changed. So if you look at all those aspects, right? India domestic demand, it continues to remain strong. Our services activity is fairly robust. Inflation is as one of the lowest. It's really moderated. And as I mentioned, businesses see India growing at 7 to 8%, even amidst all of that. So this is difficult. We've got a trade sanction from the US, and we're still able to grow 7 to 8%. So it's fairly, it is standing out compared to everyone else.
Interesting. I also wanted to talk to you about AI, Romal. You advise a lot of businesses on innovation. I've been to your innovation hub in Bengaluru. When it comes to the AI story, there is a sense that India is still playing catch up. What is your forecast for 2026 and beyond? And in terms of policies and support that maybe the government can give the private sector, what would you like to see on that front?
Yeah. So really, if you look at, AI is also India's biggest opportunity. But like you rightly mentioned, I think it's only if we move from pilots to platforms. I think we need to move away from POCs and, pilots to real platforms. So today, many Indian enterprises are really experimenting with AI in pockets. So, whether it's automation, whether it's analytics, whether it's co-pilots. But the next phase for us to be successful should be enterprise-wide and value-led adoption, where AI sort of reshapes decision-making, operating models change, and you look at productivity and not just costs. Operating models, business models have to change. So India's advantage is clearly, we have scale, which is of talent, of data, of use cases, but innovation really requires three shifts. First is you need to move from cost-led. I think we've been optimizing different things, whether it's a software code, whether it's anything else, we do a lot of optimization. That's important. But we need to move from that to value-led innovation. we've mastered frugal innovation, but the next leap is really products, platforms, IP. IP is very, very important, and of course, new business models, as I mentioned. Second is our investment in R&D and IP. I think we spend 0.6, 0.7% of GDP on R&D, which is far below all global leaders, right? Without strong private sector R&D, innovation will not scale. Third is, AI must move out of labs and centers of excellence into leadership KPIs, talent strategy, and core processes. So one of the things that you mentioned about government, really two things. One is if there are interesting aspects of AI, which is from our startup community or anywhere else, and anybody who's building that, to really provide significant amount of funding support. I mean, you compare some of the other countries, a new concept, new EV, new anything else came with a lot of EV. You have government spending a lot of money because that's not really available with others, and private sector may still take some time. Second is, it will impact, in terms of especially on jobs, but how do we reskill and how do we have job transition frameworks? I think that is critical. So India doesn't need AI pilots. I think we need AI at enterprise and economy scales.
Interesting, Romal. Thanks for a very candid assessment. You spoke about how the government needs to support innovation. And even in our survey, what has come forward is that when it comes to R&D and innovation, Indian companies are looking at maintaining status quo on that front. They want to invest, but it's not like they're really coming out and putting a lot of funding behind that. Is there a cultural shift also, Romal, that you think that the private sector needs to undergo when it comes to maybe encouraging failure? Only then will we see innovation coming in. Is that something that you are also working with your clients on?
Oh, absolutely. I mean, I think, I would put more than even funding, more than anything else in terms of more than, of course, infrastructure is needed. We need data centers. We need all of that stuff. But more than that is really leadership and culture. I think that is the most critical aspect of building any innovative society. And I think if we are okay, if we have the risk resilience and the risk capital to basically allow failure. And I think that is so important because, it's a bit like the pharma industry. You invest in 10 drugs, one may succeed, 9 may fail, but the one may be a blockbuster. And I think that's what we are seeing. We're seeing some Indian, companies do that, but we if we can see that at scale, and we already have some really interesting stuff. I mean, even if you look at some of our, the delivery in 10 minutes or 5 minutes, forget the delivery part of it, but there is some serious engineering skills that are being built, right, which is at scale. So I think we have the right set of skills. I think we just need some risk capital for people to be okay to fail.
Yeah, just to share a data point here, nearly 45.7% of the respondents said that they will keep their investments into R&D the same as it was last year, but capex 31.9% said that they will significantly increase their investment in capital expenditure. My colleague Gaurav has a question for you, Romal.
Hi Romal, good afternoon. Great to have you here. I'll just take on from the point that you made about risk capital. And historically, if you see momentous changes in innovation, the periods of innovation that have taken place across over the last 30, 40, 50 years, a large part of that have been funded by the government. So if you go back a few years, you can see in the case of internet, it was a US government defense project, and most recently, in the case of China, you can see that DeepSeek is largely funded by the state. And here we are talking about risk capital of trillions of dollars over long periods of time. So I don't think that kind of money or funds is available, or that kind of capital is available from private. So isn't it time for the government to do that heavy lifting and absorb that risk so far as capital is concerned, because that capital has to be made available. Otherwise, we probably carry the risk of being laggards in this space. What's your view?
So I think, Gaurav, the important thing is clearly where do we want to focus? We want to focus only on the infrastructure side, which is the real trillions of dollars, or we building models on data sets, our own data sets, and actually solving problems. So one fundamental aspect that I've seen in terms of some of the developed countries are largely saying, let me try to solve the big or create something really big and try to solve things. We are trying to say that let's solve every part of the government, citizen services, for example, or if in a private company, okay, just the machine line, for example, can I solve? Now, that is also okay, because it's not about just looking at AI at something which we don't know what will actually happen. So we don't necessarily need to invest all of it. Somebody is investing. We don't need to copy that. But what you're right in saying is, yes, the government needs to invest to get a lot of innovators, a lot of young startup companies to sort of start doing things that I think we need. But we also, a very important part is linking academic share as well. You mentioned about the internet, and you mentioned about, but a lot of innovations have come in actually from academic share. So our linkage
Right.
to academic share, startups, and government, of course, and identifying those ideas where you go disproportionate investment is what I would say for those specific ideas, and it'll fail. But at least, if 10 or 12 succeed at India's scale, I think we'll do for the rest of the world as well.
Absolutely.
Romil, we are days away from the budget, and the survey also throws up some interesting insights on the budget wish list. Surprisingly, corporate India is not very keen on a tax shake-up in the budget. What they are saying is that give us consistency. We don't want any changes, just keep the policy regime stable. And what they're really hoping for is more ease in compliances. I want to get a sense from you on, on these two aspects, on tax certainty and ease of compliances, and also on what would you like to see the budget address when it comes to corporate India getting back to investing and increasing the investments in capacity building in the country.
Yeah. So really, what businesses are, and maybe corporate India are looking from this budget is, and you mentioned the right word. I think it's continuity and it's execution, right? I think those are the two important words. And really four things, if I had to just sort of summarize. So our continued focus on physical and digital infrastructure. I mean, that's very important, not only the physical infrastructure, but digital infrastructure as well. And manufacturing. The one tilt in manufacturing is also to move towards more physical AI. And I think that is critical, because Asia leads the world when it comes to physical AI. Of course, India is not there. It's Japan, Korea, China, but we lead the world. So I think for having manufacturing excellence, we will need to get physical AI, and therefore every element of support from the government from a budget perspective. Second is really easier credit, digital platforms, and market access for MSMEs. MSMEs is 46% of our economy, right? So that sector, and that has a multiplier effect. So if you can really boost that sector, that I think is very important, and so sort of ease of doing business. The third is, the whole thing around tax and compliance frameworks. Even with the labor code, what has been done, what with GST has been done, I think is excellent, right? So now more people, are able to hire people without the fear that, okay, there'll be a challenge in hiring permanently, right? So I think that is critical. And the last one, I would say, an enablement for we have a significant amount of GCCs in the country. They service the rest of the world. It's also, I think, one of the best things for us to build for the rest of the world, but build for India as well. So I think the GCCs bit, I would say a fillip to GCCs, the AI adoption, and of course exports. I think, again, because with now the new trade agreements and free trade agreements, how do we enable exports as far as possible? So if we can do that, I think that's what a corporate India would look. And lastly, I would just say we're doing a fantastic job, but balance growth with fiscal discipline, because I think that is, our macro stability is really now a strategic asset for India.
All right. On that note, thank you so much, Romil Shetty, for joining us. We'll take that conversation forward with Deepti Deshpande, Principal Economist at CRISIL. Thanks, Deepti, for standing by, and many thanks, Romil, for joining us. Deepti, you heard Romil also, talking about how India's fiscal prudence and its fiscal discipline is a huge asset for India. In fact, even in the CXO survey, what we got was that an overwhelmingly large number of CXOs are very optimistic about India's growth, and they're also optimistic about India growing between 6.5 to 7%. How are you looking at that number, and how are you looking at the fiscal consolidation path that India has followed? Do you see that continuing in this budget as well?
Yeah, hi. Thanks, Shweta and Gaurav. Nice to be here. I entirely agree. I think the splendid growth inflation mix that we have landed ourselves into is clearly an asset, given the global uncertainty, given the shocks, given the fact that there is so much of unknown out there. So I think what was most important in such a situation is to get the house in order, and we've been able to do that. So our specific belief is that growth next year will be slightly lower, that is FY27. At the moment, we believe growth will be around 6.7% or so. Um, I wouldn't necessarily say it's a growth slowdown. It's more, towards a normalized growth path that we've seen over the last, decade, and somewhere we believe we will continue to traverse over the medium term. So I think that's a good, place to be in, having got the house in order. It's not only the, the growth inflation metric that one needs to talk about. It's also important to talk about the fact that fiscally we've ensured that there is discipline through the pandemic. In fact, I think it's important to look at the fact that India happens to be one of the only large economies where the fiscal deficit and fiscal debt as a percentage of GDP, these two key ratios, have materially come down after the pandemic peaks. No other country can necessarily talk about this sort of a correction in their fiscal numbers. In contrast, many of the countries are seeing much higher fiscal ratios than they did even during the pandemic. So I think these two continue to herald, an outlook which suggests that growth will be stable, growth will be more predictable. Of course, higher growth is desirable, but I think in this situation, you need more stability and you need more predictability in growth, and that's probably more desirable than bouts of higher growth and then growth coming down. So that's necessarily how we've looked at it. We believe that the government will continue to pursue fiscal consolidation. If you see the last 4 or 5 years and how we've corrected that path, we've
Right.
essentially two things have helped us. We've seen expenditure rationalization. We've seen, moving from revenue to capex is what I mean. We've seen higher nominal GDP growth, which has supported. In the last 2 years, nominal GDP growth wasn't as high as we'd like it to be, but we still managed to keep a fairly decent level of capex. Looking at the upcoming budget, I think that's going to continue. The growth prerogative remains strong. And I think the capex thrust in the economy will remain. Even there could be a little bit of a moderation, but as a percentage of GDP, it will still be pretty strong. And I think that's more important than anything at this point in time, because we are paving, the way for stronger growth ahead.
Gaurav?
Yeah, Deepti, I had a question on the fiscal consolidation aspect. Since last year, the government has announced a new fiscal policy architecture where we have moved decisively, or moving decisively from fiscal deficit as the principal anchor to central debt to GDP, the ratio of central debt to GDP as the primary marker. In this context, last year, in the last year budget, we had, the government had penciled in about 56.1% as central debt to GDP ratio, and progressively coming down to a medium term target of 30%, less than 50% by 2031. But there are a couple of known unknowns here. First, the biggest known unknown is, and it probably could turn out to be the elephant in the room next year, is then when the pay commission payouts actually are announced, and these are effective from January 1, 2026, although the monies will probably be paid sometime in FY28, which could, and this has the prospect of raising the wage bill perpetually, not just for the center, because the states will also have to take the cue. How does it, in your view, affect the fiscal consolidation glide path within the new fiscal policy architecture that the finance minister announced last year?
Right. So, Gaurav, I think there are 2, 3 things in what you mentioned. One is that, the move itself from pursuing a very stringent or a rigid fiscal deficit target to now a debt target accords the center a little bit of flexibility. What I mean by that is that if one has to reduce the debt to GDP ratio over a given point in period of time, like you rightly mentioned, there are 2, 3 things that can be done. Number one is you could bring down your fiscal deficit very sharply and get to that ratio. The other thing is you could prop up your growth, and that is one other way, or you could do both. So I think there's a combination that's possible. And like I said, compared to the last 2 years, we are expecting growth, the nominal GDP growth number, to look a little better over the next 2 to 3 years. So that itself allows a better, a scenario for debt to GDP to come down, which basically means that fiscal deficit need not come down very, very sharply beyond this, which means that the government need not curtail its expenditures very sharply beyond this. It also means that it allows the government a couple of years in the interim where it could rather increase its expenditure, it could, keep its fiscal deficit as a percentage of GDP unchanged. So basically, it allows a lot of flexibility down this path, and I think that's the number one point to keep in mind. In fact, we would soon put out something around this, and I think that's really the way to look at it. That in times of exogenous shocks, instead of moving the fiscal deficit target up and down at the risk of being commented upon as having slipped the fiscal deficit target, we might as well move the deficit targets and use it as an instrument to eventually get to debt to GDP. So like I said, it allows us a lot of flexibility. With respect to the pay commission, I think I personally think we should not preempt and bring in a lot of negativity around that, because firstly, we do not know the extent to which the pay commission increases are going to be. If you look at the past decade or more, there have been times when pay commissions did not have a significant dent on the fiscal finances, so it's possible that that comes along. So I think these couple of things are important when you look at the debt trajectory moving forward, or the fiscal trajectory moving forward.
Absolutely.
All right. Thank you so much, Deepthi, for joining us with that analysis. We have with us now Vaishali Nigam Sinha joining us, co-founder at Renew Power. Vaishali, thank you so much for joining us. How are you?
Hi. I'm good, thank you. A very happy new year to you. A little bit late though, but yeah, nice to be on your show.
Happy New Year to you too, Vaishali, and great to have you here with us on Moneycontrol. We are talking about the Moneycontrol Deloitte CXO survey, where we have surveyed 46 CXOs from across several industries, and what we've picked up is an overarching sense of optimism on the India growth story, and but one thing that stands out is that CXOs are asking for more ease of compliances and more tax stability. I want to get a sense from you, Vaishali, on, when it comes to specifically the power sector that you represent, the renewable energy space, what is it that you are seeking from this budget? What are the key challenges that you feel need to be addressed for the renewable energy sector to scale and grow grow exponentially going forward?
Yeah, no, I first of all, it's good to see the optimism which the sector has. And I just want to say that I am just back from Davos, where India really was at the heart of, I think, all partnerships. We saw the mother of all deals signed yesterday, which gives us hope that multilateralism is not disappearing, but there is diversification, and India is really the go-to partner for a large part of the world. So I guess I share that optimism as well. And I also want to make a couple of points on the positives, that while the world is talking about AI and the fourth industrial revolution, I just want to say, when it comes to our sector, we are at the sort of bottom of it all, because you do need the clean energy for us to ensure that the energy transition journey is not sort of interrupted with all the AI sort of growth we are seeing. As far as my sector is concerned, so I do see a lot of opportunity for our sector as we pivot to this fourth industrial revolution type of demand which is being generated, and India is going to be at the heart of it. I think from a union budget perspective, I think I would say that there are a couple of things I want to see. One is on scaling up manufacturing, and it's not only about scaling up manufacturing, it's really about leading pathways to high-tech manufacturing. I think that is what is going to be the demand of India. So how can we provide incentives? We will look to the budget for incentives to increase competitiveness and, I guess, sophistication in being able to perhaps look at the manufacturing piece, then we are also looking at a lot of R&D, sort of intensive policies, because I think that is going to be critical even for our sector. If I look at solar manufacturing, so I think some incentives around PLI will help us scale up and move from a manufacturing to a high-tech kind of opportunity which India needs to tap as well. A couple of things which I think we are facing as far as problems are concerned is solving for our delayed PPAs. As of this month, there were about 45 gigawatts of renewable energy capacity in India which faced delays, I guess, in signing PPAs. So policies to perhaps streamline some of these PPAs will be crucial. We will be looking for that. And I also hope that we can include solar cell and module manufacturing equipment under PLIs to deepen the domestic supply chain. Right, and then access to financing has been an ask for a long time. So as far as solar and BESS manufacturing is concerned, if it can be categorized as an infra category for RBI's ease of lending, I think it will benefit the sector.
Right, Vaishali. Vaishali, we've also, sealed the deal, as it were, with Europe, and what is being described as the mother of all deals, the FTA with Europe is finally looking like a reality for us. It has far-reaching economic and geopolitical consequences for both countries. I want to get your views on what does this FTA mean for your sector and India Inc. at large?
Yeah, so I think definitely, as I said, rewind last year, we were looking at global multilateralism disappearing, right? This is a real comeback where, actually the US tariffs have, I guess, around every dark cloud is a silver lining. So this has been a silver lining, a deal which has taken, I think it was close to 20 years, right? It was in the making for it to come, is really going to boost a lot of sector. I think more, importantly, sectors which have been impacted by the US tariffs, like, gems and textile and the shrimp and the industry and so on and so forth. As far as our sector is concerned, I do believe it's going to be a mutual gain. As I mentioned, that, for manufacturing, we are really looking at upping our game from becoming a manufacturing hub to really a high-tech hub for manufacturing. And a lot of R&D is being done in Europe, and we can actually benefit from that partnership to be able to learn from each other and perhaps up our game as well as far as high-tech manufacturing is concerned. And I see that as a real opportunity. Of course, as far as data centers, etc. concerned, there is energy sort of crisis happening in Europe. We can probably get some of that demand also here in India. We are seeing a lot of other countries look at India as a hub. Perhaps we can expect more from Europe there. Of course, not much was seen on CBAM, unfortunately, but I guess we should be patient. Not everything comes out at one time, but over the coming months, I hope to see more on that front as well with respect to green hydrogen, because that is going to be a big sort of unlock for our sector as well.
Right, Vaishali, stay with that thought. I just also want to welcome Mr. D.K. Srivastava, Chief Policy Advisor from Ernst & Young, who has joined us. Mr. Srivastava, thank you so much for joining us. You're joining us from very warm Chennai while we are here in cold and rainy Delhi. Thank you.
Indeed.
Always a pleasure, sir, to have you here with us on Moneycontrol. Very quickly, Mr. Srivastava, I just want to get in your initial thoughts on the optimism that the CXOs have expressed on the Moneycontrol CXO survey that we've conducted with leaders across industries, and we've spoken to 46, we've surveyed 46 CXOs, and they are extremely bullish on the Indian economy. Mr. Srivastava, do you think that optimism what do you think of that optimism? Are they being overly optimistic? Are they being politically correct? Or do you think that there are several reasons for the CXOs to be bullish on India at the moment?
Well, I think it is quite reasonable for for all of us to be optimistic about India's macroeconomic fundamentals. We have done very well in terms of GDP growth in real terms. We have actually tried to neutralize all the tariff-related issues and supply chain issues that are arising through global uncertainties. But in spite of that, I think we have to really be very cautious in terms of continuing with our optimism. So, if I look at it from the viewpoint of the budgetary prospects, the first question that, in terms of expectations, one asks is whether the budget is going to be expansionary in terms of the overall size or fiscal intervention by the government. Now, as far as Government of India is concerned, what I find is that from FY25 to FY26 revised estimates to FY27 budget estimates, I find that the size of government measured with respect to total expenditure of government relative to GDP, it has been going down over these years. So it was actually 14.1% of GDP in FY25. It came. We estimate that this will be about 13.9 in FY26 revised estimates, and will go down further to 13.6%. So, in terms of the budgetary support, there may be possibilities of structural shifts, but the overall size of government intervention or government demand is actually coming down. So, that is one aspect with respect to which we need to be cautious of. The second thing is that, of course, most of the major tax reforms have already occurred in terms of the PIT reforms and the GST reforms that were undertaken in FY26 and the earlier CIT reforms. But all of these reforms have actually led to some kind of at least immediate reduction in the tax GDP ratio. So, to finance government expenditure in the face of a reducing tax GDP ratio and still maintain a credible fiscal consolidation path is also going to be a challenge. So now there, I find that last year, for example, in the budget, it was indicated that the strategy of fiscal consolidation is going to change, and that is to ensure that the debt GDP ratio would come down on an annual basis, although we may not target any particular fiscal deficit to GDP ratio over the medium term. Now, what has happened is because of the fact that the nominal GDP growth in FY26 has turned out to be, at least in terms of the first advanced estimates, only 8%. Now, that would mean that even if we may succeed in achieving a reduction in the fiscal deficit to GDP ratio of 4.4% as budgeted last year, it would still mean that the government debt to GDP ratio will increase in this year, although by a very small margin. In fact, calculations show that if we need to achieve a 4.2% fiscal deficit in FY26 in order to remain at the same level as last year. So that means that missing that annual strategic change in fiscal consolidation in the very first year, and not much to do with in terms of fiscal consolidation effort, but because of the way the nominal GDP growth rate has gone down. So there are some of these areas of concerns that we might be mindful of.
Absolutely, Gaurav. This is going to be a budget where the finance minister will really have to do that balancing work. I believe you have a question for Ms. Sinha, who's standing by with us.
Vaishali, it's good to hear about the prospects of the renewable energy space in India. You did mention briefly about solar. Just to put things in context, a large part of India's ability to scale up the AI value chain will also depend the extent to which we are able to set up data centers which require significant volume of uninterrupted high quality power supply. And India has in many states, particularly Rajasthan for instance, if you take that as an example, nearly 325 days of sunny days where the sun is out. There's tremendous potential to develop states and districts like this as global solar capitals. Is there a case to actually make us solid pitch for India to turn out into some kind of a global capital in the solar energy space in a manner similar to what the Netherlands is in the wind space?
Yeah, sure. No, absolutely. I think that's a great question. And, we've seen at a subnational level, there's been a huge amount of, I would say, competitiveness amongst the states to invite players like us to be able to supply clean energy to companies, the hyperscalers who are setting up shop here in India. So we are already well positioned. The way I see, this budget is really like I think 5 years, we have seeds being planted for half a decade. I think the geopolitical shifts, the emergence of India as a fast-growing economy, and especially in the clean energy sector as being the highest performer in terms of deployment, I think we are clearly a country of choice. I think states have actually also stepped it up a little bit. We are already seeing progressive friendly policies. So if we can see a long-term policy sort of mindset and some sort of seeds being sown in this budget, I think for perhaps not only looking at capex for roads and bridges, etc., but really crowding in private investment, lowering logistics costs, setting up, large industrial corridors, which will help us speed and scale for execution, for the fourth industrial revolution. So the geopolitics, and which will make for better policy and public-private partnerships and global partnerships, and most importantly, readying the people of India through skilling, not only to understand AI, but to be able to deliver an AI, I would say, trained workforce. I think those are the sorts of policy announcements which we often look for in the budget, which I will look for. And of course, it's really all about deepening the supply chain, building our infrastructure to meet the needs of the the new, I would say, fourth industrial revolution we are seeing. So anything which can, in our sector, we saw that industrial corridors, large parks helped us, deploy better on the ground to solve for acquiring land and so on and so forth. So I see that perhaps some announcements for industrial corridors, which will help us to do business with ease, to scale. And basically, it's all about execution, right? So smarter deployment is what I would like to be able to see and infer from the announcements in this upcoming budget.
Right. Let me also bring in Mr. Srivastava here. Mr. Srivastava, the budget is barely 3-4 days away now. And, you flagged low nominal growth as a concern. In such a scenario, Mr. Srivastava, what do you think are the options for the government to really maintain its target of reducing its debt to GDP ratio without compromising on essential capital expenditure?
Capital expenditure, in terms of its emphasis, that has been on physical infrastructure, that has to change, because the absorption in physical infrastructure has come down, and what we now need is to shift the capex structure of capex in favor of defense capital expenditure, and also in terms of modern advanced technology sectors such as the AI and data centers and so on. So that's where we need to really continue to maintain capex growth momentum, so that the private sector investment can also be crowded in. And as we go along, somehow I find that we have to really get the tax buoyancy back. Unless all the changes that we have done so far, in the medium term, the personal income tax is the only one that showed a consistent higher than 1 buoyancy, even though that has been eroded in the current year. But CIT reforms very extensive, but so far we have not picked up the buoyancy in the case of corporate tax, and nor have we, and GST also. This year, the reforms involved considerable reduction in tax revenue. So, in order to sustain a steady support from the side of government to the economy, we really need to maintain an expenditure level which is rising marginally. And then we can work on the structure of that expenditure. Now, there the government succeeded in terms of bringing down the share of revenue expenditure over time, primarily based on reduction in the share of subsidies relative to GDP. That has been a very positive structural change that actually led to opening up of fiscal space so that capital expenditure could be increased. And over the last 10 years plus, we have been able to increase the share of capital expenditure, government capital expenditure in government total expenditure by about 10 percentage points, which has been a very desirable change. But what is now needed is to somehow ensure that our overall tax GDP ratio becomes what is consistent with what is required for the medium to long term. That is languishing below 18%. There was, for a very brief period, we exceeded 18% of GDP. I am talking about combined tax GDP ratio, central and state governments. Now, unless we increase that 18% tax GDP ratio, and we have stagnated in this range of about 17 to 18% for more than about 3 decades. So, unless we increase this to something like slowly towards closer to 25% of GDP, unless that is done, the government will not be able to invest in the sectors in which it wants to invest. It will not be able to support the initiatives in private initiatives in those sectors where it was to see the investment go up from the private sector and so on. So we need to really work on this strategy of balancing tax GDP ratio, expenditure GDP ratio, and debt GDP ratio. That's where I find, at least temporarily, there are certain challenges that are opening up.
Right.
Yeah. Gaurav?
Yeah. So, Mr. Srivastava, just taking on from the point that you just made on fiscal consolidation and tax and debt to GDP ratio, I have a specific question on, while the entire focus has been on the central government's expenditure quality and its ability to contain the borrowing levels within a certain level. There is also the question of state borrowing, and within state borrowing, of course, there is also the question of off-budget borrowings, and the Uday scheme within the power sector is a prime example of that. How do we actually juggle both these objectives? Because unless state borrowing is contained in a similar manner with a similar rigor of fiscal discipline as we are currently seeing on the central side, the combined borrowing by center and states will likely to remain high for long times to come. And then, of course, there are other questions that are going to come about in the next couple of years. One, of course, is the obvious one is of the pay commission payout, which is going to push up revenue expenditure, which could mean that all the effort of the last 10 years or so, particularly from 2017, when we have been able to bring down the proportion of revenue expenditure to about sub 75 kind of percentage kind of levels, will again keep rising from next year, because the wage bill is a revenue expenditure that will keep on rising perpetually, isn't it? So how do we deal with it?
Yeah, very, very pertinent questions. Now, we should examine this question of combined borrowing from the central and state governments in the perspective of the Fiscal Responsibility and Budget Management Act, which was last amended in 2018. According to that, the combined fiscal deficit of the central and state government should be 6%. That's the target. And the combined debt GDP ratio should be about 60% of GDP. Now, what has happened is that the latest available data indicates that the state governments have incurred a fiscal deficit of 3.2%. In fact, the central government has been encouraging the state governments to borrow beyond the limit of 3% by extending to them interest-free loans subject to certain conditions.
For 50 years, yeah.
For the 3 to 4 years, post-COVID years. So, as a result, although earlier they were not borrowing up to 3%, but now they have exceeded that. Along with that, there are power sector reforms that also involves off budget borrowing and so on. So we need to really bring all of this borrowing together. Unless we consider this entire question in a consolidated way as to what is the borrowing space available in the system, as compared to that, how much is getting borrowed by the central and state government. So right now, the information is that we are borrowing together about 7.5%,
Right.
close to that range. The borrowing space is not that much because actually household sector's financial saving has come down over time. It is clocked at now 5.2%. To that, if we add some inflows from abroad, we have a borrowing space of at best about 6.5 to 7%, not more than that. On
Right.
that space, everybody is going to claim public sector, non-government public sector, government proper, and then the private sector. Therefore,
Absolutely.
the equation is not in favor of government continuing to borrow at this level. That is central and state governments together. On top of that, you have indicated that there would be an additional uh, pressure on the state finances because of the revision of pay and salaries and pensions and so on. That is going to unfold towards the end of this FY27 and so on. So we really need to increase the tax GDP ratio, as I was saying earlier.
Right.
Only then your borrowing needs will come down. So we
Right.
have to juggle this in a manner such that the whole thing can be planned in a medium to long term perspective, and the path can be calibrated where we have a clear path of all of these macro parameters.
Absolutely.
Right. Let me also bring in Vaishali here. Vaishali, when we go look at our survey and when we surveyed the CXOs on the investment plans, they said more or less the same in 2026. I want to ask you a very Renew specific question. What's your project pipeline looking like for the next 2 to 3 years? Do we see Renew amping up investments? And if yes, in what states and in what areas?
Yeah, sure. No, absolutely. We have a robust pipeline. We have about 13 gigawatts of installed capacity and projects on the ground. And, in terms of a pipeline, we are at 23 gigawatts, so pretty robust. I think, it's really about deployment and, our ability to be able to execute. As I'd mentioned, the drivers are subnational level. I think all the states are really inviting private sector players to partner with them to set up large, parks, whether it is industrial parks, whether it is for data centers, whether it is for manufacturing. So I think our sector in India, I think there's an economic case for it. And so therefore, whether it is the public sector or the private sector, I think we are all committed. It's not a nice to do climate thing. It is really at the backbone of many other sectors as well. So we do see just focused growth. I think capital is in abundance in this sector. Of course, how we can make the cost of capital better and leverage it better is something I'll be looking to this budget for, to see what shifts we can have. But it's really about not that much about adding capacity. It's going to be more about executing, integrating, for our sector and for other sectors, for India Inc. and Global Inc. at large as well. That's what I see. Perhaps we will look for solving of the PPA problems which I mentioned, and I will also be looking at moving the whole manufacturing sort of segment to high-tech manufacturing and incentives for that, and especially PLIs for R&D, etc. And I think one other PLI I will be looking out for is for the best manufacturing, which is very important for us, across the value chain. So perhaps do business as usual, and there is a lot to be done, and that's the good news. Sector to be
very quickly, Vaishali, very quickly, you've delisted from NASDAQ. Any plans for an India IPO?
Well, just correct. We haven't delisted as yet, and that's public information, and that's all I can say as a listed company. As you know, I cannot make forward-looking statements.
Fair enough. Very quickly, also, Vaishali, just to get a sense from you, we've just signed, we've closed the deal with on the FTA with Europe. How exposed is Renew to supply chain risks from China? And you mentioned that with this FTA, it gives Renew and other companies like yourself access to a lot of innovation and tech that's happening in Europe. So does this act like a buffer for you, and how exposed are you when it comes to supply chain risks from China?
I just want to say that not now, but it was post-COVID that we figured that self-reliance on domestic supply chains was crucial, and the government also perhaps understood it, and hence the PLI schemes which are rolled out have really helped us in our self-reliance journey and securing our supply chain. So as lot of people are now saying it's not a China plus one strategy, it's an India plus one strategy. It's taken us time to ensure that we have been able to decoupled to a great extent from China and are reasonably comfortable. And I think with some more policy incentives and PLI schemes, we will be able to deepen and strengthen our supply chain. So we're doing good. Our manufacturing business, which is all about 3 years old, is super profitable, which is always the good news and indicator of how well the sector is doing, and how self-reliant India has become over the last few years, courtesy the policy framework and also execution on the ground and getting things done, creating a supply not only for ourselves as Renew, but for our other stakeholders in India and perhaps globally as well, as we will see with the EU trade agreement.
All right. Thanks so much for that, Vaishali. Let me bring in Mr. Srivastava here. Mr. Srivastava, again, the India-EU FTA, how much does that, buffer us from the geopolitical risks that we've seen emerging from the United States? And also, very quickly, Mr. Srivastava, what are the 3 things that you would like to see Ms. Sitharaman do in this budget that you think are the absolute imperatives for the Indian economy at this point?
Well, I see tremendous potential in this FTA that we have now undertaken with the European Union. But it is going to be dynamic and evolving. It is something that will not happen by itself. And therefore, both the private sector and the government will have to really take advantage of the openings that would become available.
Close.
I particularly think that there is tremendous scope in the fact that along with this, there was an agreement also, a strategic agreement in terms of defense co-production and co-development. That's where maximum potential will lie, and that's where the budget should also now allocate higher amounts so that this co-production and co-development can be encouraged, especially in defense initiatives, but also in terms of the advanced technology sectors such as data centers and artificial intelligence and so on. In all of these sectors, Europe has the necessary technology, at least it is in the front ranks. And India can really initiate a number of joint ventures in all of these areas so that we can access not only our large domestic market, but also the European market, in fact, the world market as a whole, and give them the benefit of economies of scale. So I see tremendous potential in this, but of course this is an evolving scenario and it much depends on how we play at it.
Absolutely. Also, very quickly, as a former member of the Finance Commission, Mr. Srivastava, what will you be looking out for? Because the day of the budget presentation is also the day for the 16th Finance Commission recommendations to be made public. What, according to you, would be an ideal division, and what would you be looking out for?
Well, in the longer term scenario, we look for a system of fiscal transfers that leaves both central and state finances in good health. excessive transfers from the center to the states or deficient transfers from the center to the states are both problematic. So the Finance Commission is supposed to really establish that kind of balance, which will leave both tiers of government in suitable fiscal balance. And that is what we are looking as far as the vertical question of transfer of sharing of resources between the central and state governments are concerned. On the horizontal side, that is interstate distribution amongst the states, we look for a system where the content of equalization in overall transfers, so that justice can be done to the lower income states and justice can be done to the mineral rich states. Those are the states that have suffered so far. That horizontal system should be such that these two states also experience a bit of the benefit which is due to them in terms of the growing Indian economy, macroeconomy, and so on. So that's what we look for, a balanced vertical arrangement in which neither side suffers, and a more equitable horizontal distribution system.
Yeah.
Right. Thank you so much for that, Mr. Srivastav, and a big thank you to Vaishali Nigam. And of course, thank you to Romal and Deepthi Deshpande who joined us early in the show. Gaurav, a fairly exhaustive conversation wherein we covered different aspects. And of course, the genesis of it all was the Moneycontrol Deloitte CXO survey, where CXOs have shown so much optimism. What's the one thing that stood out for you in the survey?
So, one of the things, I believe that this budget is going to be the first one where it's going to be, where artificial intelligence is going to be a big focus area, because India now needs to leapfrog onto the global high table. So I would not be surprised if there is a big budgetary grant set aside or funds being set aside for India's artificial intelligence plans. Please do bear in mind that the budget comes just 19 days before the Global AI Summit takes place in India, where a lot of brainstorming is going to take place right here in Delhi, and I think the budget is going to set the tone for that.
Right. Thanks, Gaurav, for that. And like our survey points out, that CXOs don't want any tax shake-ups. What they're really looking for is policy certainty. They want stability, and they want ease of compliances, which also, as we've been told, would be a big area in this budget. We are expecting a whole host of reforms when it comes to ease of compliances, decriminalization and digitization. That's something that we can look out for in this budget. And of course, you can get all the details of this very exhaustive and the most definitive CXO survey on our website, moneycontrol.com. We are also on X and across all social platforms, where we've broken down the survey into several stories and very visually appealing and easy graphics to really give you a snapshot of what India Inc. is hoping for and what India Inc. thinks most importantly. Because Gaurav, the fact is that it's easier to get politicians to talk, but very difficult to get business leaders to really speak very candidly. I think they are more politically correct than the politicians themselves. But I think we managed to scratch the surface on on that one through this survey.
Yes, absolutely. And like has been the case over the last several years, almost 20 years or so, if you ask the businessman to rate the budget on the day of the budget, the average would be around 8.5 to 9.5.
Absolutely.
Regardless of whether the budget measures have actually affected the businesses negatively, the ratings will always be high. So as you rightly said, business people in India are more politically correct than the politicians themselves, but that has been the norm so far. But despite all of this, clearly our panelists and experts have really dived deep into the details of it and have told us what the challenges probably could be.
Right. Well, with that, it's a wrap from all of us here at Moneycontrol. Do keep following us for all the exclusive insights on the budget and markets. Thanks so much for watching. Goodbye.